Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark on the yen dropping due to negative interest rates. Business consultant Don Mosher is disturbed over-regulation is choking the venture exchange. And Tim Cyclesman Wood warns equity markets will continue to fall for quite some time. We'll talk to Ross Clark right after this.
Always consult your investment professional before making any investment decision.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Yes, Jim. Nice to be with you.
A bit of a bounce in the equity markets that have had their worst opening month of the year ever.
Well, I mean, that first 2 weeks was clearly the worst ever. The last 10 days here has been quite a recovery. We've recovered about 40% of the losses, and considering the extent of that first 2 weeks, this is a pretty impressive close to the month. That we've still got to be pretty careful here that we don't go back down and retest those lows. The classic election year cycle would have a second half January to mid-February low and then have a decent rally into March, April. So, maybe there's one more test of the support underneath us at this point. But the market's it's reversed, and it's not just the equity markets. We've ended up with the commodities turning. You've had crude oil gone from $26, closing this week now at $34. And we've talked about the commitment of traders numbers and the bearish sentiment that was out there in the oil market for the last few weeks. So the reversal a week ago and now the follow through was pretty good. And especially considering the middle of the week on oil, you had the first statements out of Russia that they were interested in talking with other oil producers about a 5% cutback, and the others immediately, like Saudi Arabia stated no, we're not set to do one of those meetings. So you got a little pullback after that, and then the next day you get some terrible inventory numbers on crude oil, and it shakes that off. So, it's always important to see how a market does. If you give it bad news and it can manage to do well, it's got some buoyancy underneath it. So we're into the favorable seasonal period for the oil and for unleaded gas. So I would expect that for all we might see a bit of resistance in the $35 to $36 range and a bit of a pause, I would think that we've seen the bottom in here for oil for now.
And plus, we're going to have our annual springtime refinery fire that always boosts the price of gasoline.
Oh, yeah, and that's, they're already pricing in about a 25% premium into those April and May contracts. So the market's ready for that, but usually the advance is larger than that. So we've been recommending playing the gasoline as a long side trade, and any of the oil service stocks right now, which have been beaten down so badly, I think have got a fair amount of upside potential still left in them.
Is gold going to make a move soon, or do we have to wait until the end of the year?
Well, I think we're going to have to wait. One of the things we talked about a year ago, and we had the bottom in gold, and then we saw the bottom in the crude oil about 2 months later. We've got the same type of thing happening now. We had a bottom in gold the first week of December, and now you've had put in this low in crude oil, and typically the crude oil low will follow the gold low by 1 to 3 months. We've done that. And now as you see buoyancy in the oil market, the gold market then has difficulty progressing higher. So I think that anything in the 1130 to 1140 range in gold is going to be a pretty reasonable cap in here. And we do have, from a cyclical perspective, we talked back in December as it was coming off the lows that this rally was probably good enough to take us for a good 6 to 8 weeks into the latter part of January. We're there now, and it's starting to look a little bit tired. A few weeks ago, we talked about how the 1077 area would be a pretty critical support. It managed to hold that on the pullback and bounce. I think at this point now, you want to be looking at levels in the 1112. Anything below that would suggest that this upside momentum is lost. And the next cyclic period we'll look for will be the end of March, first week of April for a potential low. Wouldn't be surprised if things start to come unglued here that we're looking at new lows.
Japan has made a move, and they're now on what some people would call the dark side.
Yes, we've negative interest rates. They're joining the parade that happened over in Europe. It knocked the wind out of the yen. The carry trades saw a lot of action today with the euro versus the yen, and I would suggest that everybody's in a competition to the bottom as far as their currencies are concerned. The key question now will be what does China do in the next couple of months? Because with the competitive action by the Japanese, it would be natural for China to look to do something.
Well, if having a low dollar was a panacea for everything, Canada should be booming.
Well, should be, but now, we've had a pretty reasonable bounce. It's a shame that it didn't have anything to do with the strength of the economy, but more what was going on with the commodity prices. We have had a good 3-cent bounce off the lows here. I was thinking that we would be looking at something around 3 cents as a nominal rally. We are very, very close to getting overbought at the end of this week. And I wouldn't be at all surprised that there's not much more than another half cent or so left in the current rally.
We'd have to see oil go up quite a bit more to see another boost to the loonie then.
Oh yeah, and if the typical move off a hard break like we saw in oil is that you're going to have 5 to 7 good hard up days because you've got all these short positions that are coming off because we were very, very overweight in terms of the speculative shorts. And those positions take time to come off. So we had the first wave of buying. It was 1 or 2 days. We've had a pause, and now we've had, I think it was a 4-day run here this week. I think that the bulk of that short covering will be over very, very soon, and you'll get into this consolidation phase. And if that's what happens in oil, you probably see this Canadian dollar start to find overhead resistance and start to roll as well.
Ross, thanks a lot for chatting with us.
And we'll be with you next week, Jim.
Coming up on This Week in Money, Don Mosher about the crisis facing the venture exchange.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Don Mosher, business consultant, his website venturebeacon.ca. Welcome to This Week in Money, Don.
Thank you very much. Pleasure to be back.
We've done a number of shows about people being very concerned about the TSX Venture Exchange. Are there any chances that the exchange will be improved? I know there was a town hall meeting about the Venture Exchange Thursday in Vancouver. Who was there and what was said?
There were probably 400 very concerned participants that play in the market. I would say a mix of accountants, lawyers, company executives, some investors, and hidden amongst the group were, I understand, employees of IROC and the Commission that were noticeably silent through the entire thing. And, it got off to a roaring start as soon as the president of the TMX group got up and started to address everybody about how we were the best venture marketplace in the world. One of the participants in the crowd yelled out, "Used to be." And that more or less set it off. So when Mr. McCoach got up to try and do his brief presentation on the white paper, he got continually disrupted by people yelling out questions and comments at him. And he was really trying to say, not everybody in the room has read the white paper, so let me run through a quick presentation on it, and you'll all get an opportunity to speak afterwards. But nobody was willing to wait for that. One of the guys in the crowd yelled at him as soon as he started out, "Just forget about holding our hands. Let's get on with it." And McCoach was, "Well, not everybody's read it. Let me run through it. It'll work better." He struggled through it. He got through his presentation eventually, but, it was disrupted constantly, which is, I guess, what you'd expect by a bunch of very upset people.
What was the feeling after his presentation? Was it worth the wait?
Bottom line on this is he can say whatever he likes up there. He started out by addressing the three promises they have on the front page of the white paper. We will reduce our clients' administrative and compliance costs in a meaningful way without compromising investor confidence. So, what they're looking at is PIFs, for example. Guys that have been on multiple boards and having to renew their PIF every 3 years and having to refile PIFs every time they take on a new position, they're going to turn it into a nexus type of thing where you only have to do it every 10 years. Automated online filings, an accelerated transaction process, eliminating the general requirement of sponsorship, things like that they can address. But the bottom line is, unless they get the cooperation of IROC and the commissions, they're irrelevant. It's IROC and the commissions that have put up barriers to the public. Definitions like the accredited investor definition, which only allows 3% of the Canadian public to participate. Yes, the Commission's starting to address a couple of things. They simplified the rights offering because rights offerings did not work. They made no sense at all. You're forcing companies to undergo a full Commission review, although they've got mandatory disclosures. Why would you go and have to review before you could put out rights offering? So it took the Commissions a full year to implement something that was logical and should have been that way in the first place. And now they've come in with, if you go through a broker, you can take up to $15,000 down in a financing that comes with a prospectus. But again, you're putting all the liability on the brokers. Well, the problem there is IROC has more or less come in with all their terms on suitability, risk tolerance, long-term targets and everything. And does a broker want to take on all that liability? And then on top of that, there were no representatives from the shareholders of the TMX, which represents some of the largest institutions in Canada, saying that, you know what, we will support the company that we own shares in. We will launch institutional coverage. We'll launch analytical coverage. We'll encourage our corporate finance to come help raise money for you juniors. We will encourage our brokers as opposed to forbidding our brokers to sell these products to their clients. Without all that support out there, the venture exchange is running a real risk of ceasing to exist because the brokers that do support the venture exchange, which are the boutique firms, are rapidly being put out of business. There's 7 left in Western Canada now. There used to be close to 40, and they're being put out of business by IROC. It is like an intent to destroy those firms and make sure they don't exist any longer, and they're doing it through compliance costs and increased liability that make it impossible to make money or even survive as a firm.
Do they realize what kind of damage they could do to the Canadian economy if we don't have a venture exchange?
They don't care. What you've got is a bunch of bureaucrats that are completely risk adverse, regulating a risk market. All these guys have 6-figure salaries, very secure jobs, expense accounts, inflation index pensions. All they care about is protecting their job. If they do something that results in any kind of fraud that's covered in the paper, their job's at risk. So what they're doing is shutting it down and therefore feeling that their job's secure. I think they're wrong.
I was going to say, how do you have a secure job if the venture exchange shuts down due to lack of business?
Well, they don't believe they've done that kind of damage. They're too ignorant of what they've actually done. That's the worst part, because they've never been involved in any kind of entrepreneurial situation. They're just bureaucrats that have walked into jobs during good markets. They've continued to pile on regulations. The markets have continued to function, but now that we're into a low commodity cycle, and now that the Canadian economy is under pressure, the regulations that they've imposed on us are starting to come home to roost. And it's gummed up the works. You know, if you compare it to a car salesman, a 17-year-old kid walks into a car lot and buys himself a Ferrari, a Porsche, a Lamborghini. We see lots of them running around Vancouver with N's and L's on the back bumper. That's an investment of $200,000-$300,000. Is there anybody questioning suitability? Is anybody questioning the risk that is going to be imposed on the highways? The potential is to kill somebody. And does anybody ask about, long-term target for the investment? We know it's going to lose money when you drive it off the lot. No liability imposed on the salesman that sells that car to that person. On the other hand, if you want to open an account for $10,000 or $15,000 with a broker, you're going through a 15-page disclosure document and all the liabilities imposed on the broker, regardless of what you do. He should have known it was unsuitable for you. He should have taken risk into account. Brokers are getting nailed now, even though the account is purely speculative. So they don't care. They don't understand it. And by the time the ramifications, which are now starting to occur, hit home, and maybe at some point in time the media picks up on this, it'll be too late. That town hall meeting had no mainstream coverage at all. You're covering it. Stockwatch covered it. You didn't even see it on BNN, let alone CBC, CTV, the Globe and Mail, the Financial Post. Mainstream media is not covering it, and as a result of that, the Canadian public is blissfully ignorant as to what's going on.
And you said only 3% of the Canadian population qualifies to invest. How has that made it an exchange that is useful for raising money?
Well, that's the problem. They continue to impose these things, flying the banner of protect the public. In some regard, I would call these guys economic terrorists. You could call them the Canadian version of the IS. Impede speculation. Big black banner with white lettering on it that says protect the public, while they plant EIDs under the foundations of the Canadian economy, which act as an incubator for future job and wealth creation. Every time they put one of these regulations in place, if you visualize it as an explosive device, that's what they're doing.
Well, if they were so concerned about people 65 and older keeping their money in a safe investment, how come they allow them into casinos?
Well, even a better comparison than that, Jim, is Shane Nyquist, I think you interviewed the other day, and he brought it up. He sold a house the other day for $3 million. It entailed 2 signatures. A $3 million investment, nobody decided suitability of the investment. What's the risk on that $3 million investment? None of that stuff is looked at because it's real estate, just like none of that stuff is looked at because it's car sales. But when it comes to the Canadian capital markets, which are the foundation of this country, all of a sudden we need all this protection for the Canadian public. So secondary to casinos and lotteries and any other way that you want to blow your brains out financially, they've decided that the capital markets, with audited financials, vetted management, and full disclosures, mandatory disclosures, that industry needs to treat every single person in it as a criminal.
You're listening to This Week in Money. I'm Jim Goddard. We're speaking with Vancouver business consultant Don Mosher. If the venture exchange does what it can to improve things, will IROC and security commissions also improve what is needed to be done?
I very much doubt it. I don't think they understand it. They pretend that they're paying attention to it. And the commission, yes, they have passed a couple of things lately, which I applaud them for, both on that prospectus exemption and in regards to the rights offerings. But if they really want to do something, do away with the accredited investor definition. It makes no logical sense at all. And over on the other side, who the hell is IROC to tell me at the age of 60 what I can and cannot do with my money? I've raised a family. I've managed to stay financially sound all these years without some person that does not know me at all deciding what's right for me to do. And it goes for every Canadian citizen out there. The population of Canada is completely ignorant to the fact that their rights are being taken away by a group of people that claim they're protecting them. You have the right to do everything else, but you can't play in the capital markets. It's an unlevel playing field that is very much tilted towards the wealthy in the country and towards the banks selling their proprietary products. Most of the stuff that IROC is imposing right now is because they say it's a conflict of interest for humans to advise humans. IROC and the OSC gave $2.5 million to an organization called Fair Canada. They call themselves a charity organization, representing fair representation for Canadian investors. What they are is a lobby group for the regulators to push for more regulations. And what they're pushing for is robo-advisors, because they say there's too large a conflict of interest when there's a human advisor advising a human client. Well, let's take a look at the conflict of interest with the banks selling their own proprietary products and continuing to gather a majority of the wealth in Canada under their arms. They've got people's mortgages, they're selling them insurance, they're selling them proprietary products, they're holding on to their savings account, checking accounts, personal debt, the whole thing. It's incredibly one-sided when it comes to conflict of interest.
Are governments aware of the problems on the venture exchange and aware of the damage the current regulations are doing to the economy?
You know, the only time you can believe a politician or a majority of politicians is when their lips aren't moving. You know if they're moving, they're lying. They get funded by the big corporations in Canada, and the biggest corporations in Canada are the banks. So they're pretty much the beck and call on the banks. Anytime they're looking at advice when it comes to the economy or anything else, they rely on the banks. So the banks are driving this whole thing forward. And in the meantime, Canadians are losing all their freedoms.
How important is the venture exchange to the Canadian economy, and what has it done in the past?
Well, we really don't know what it's done in the past unless you go all the way back to the Depression when we had some major failures. I guess the most recent thing would be the real estate collapse in 2008, where you saw $7 trillion lost in the U.S. because the banks were packaging up a mix of mortgages and selling them off as guaranteed investments. Up here we managed to skate through it because, you know, you needed to put down 10% on a mortgage, and our real estate market wasn't involved in that kind of leverage. Next time around, I don't know about it, because if you look at the real estate prices in Vancouver right now, like 30-year-old kids that are having their first children are buying $1 million, $2 million houses. And if the money quits coming in from China, I think it could be a dramatic collapse in real estate prices both here and in Toronto. They're feeling the pain of it in Calgary right now. But our unemployment statistics aren't even accurate, because all they're running it with are people that are employed by companies. How about all those people out there that are self-employed, contractors that aren't getting work in the commodities industry these days? I don't think, if you're not collecting unemployment, you're not in that database. I think it's much, much worse than we know it is.
How long can the venture exchange last if dramatic improvements are not made?
Well, we're going to come into another audit season here shortly, the end of April. And I think that's going to be pretty telling. That was one of the discussions that kept popping up at the TSXV meeting, was the zombies on the board and why they haven't been thrown off the board yet. And Mr. McCoach was saying that, well, we do follow our own rules, and, we have dealt with this issue. But I think this time around, it's going to be very telling. But the other thing about it is it also tells you how resilient these junior companies are, because this has been a serious issue for over 5 years now. It's gotten worse and worse and worse, and maybe we finally gotten to the bottom on it. But there's a lot of companies out there that aren't worth the paper they print, and here's the TSX has not suspended their CPC program, so they continue to print crappy paper with no value, with the idea that businesses are going to use the CPCs, and if they cared about the investor in any way, shape, or form, they would be pushing people into using these vehicles, revitalizing them, refinancing them, allowing a simple change of business, suspending the CPC and IPO program, and limiting the number of companies coming onto the board. And when they want to diversify that board away from its majority resource sector right now into more biotechs and high techs and just real businesses, they should be forcing RTOs on everybody. That's what they should be doing.
Don, would it be accurate to headline this interview as the engine room of the Canadian economy is close to collapse?
Yeah, that'd be a pretty good one. The incubator and engine. It really is an incubator. What we're dealing with here are infant companies, And just like human infants, they're much more fragile to their environment. You're not going to take a baby out of the womb and throw it out into 40 below weather and expect it to take care of itself. You're not going to expect it to feed itself. You're not going to expect it to use bathroom facilities. You understand it's an infant, and you nurture it, and you allow it to grow. And that's the way the venture market needs to be treated. It needs to be nurtured. Quite the opposite from that. It's being treated no differently than the banks that are overseeing this complex in the first place. And in the meantime, the big institutions have literally banned their investment advisors from participating in these junior markets. So nobody's nurturing it anymore. They're trying to kill it.
Is Canadian investment money going elsewhere, overseas?
Absolutely. I had a British guy in my office yesterday who is a full-service broker in London. And one of his side businesses is taking venture companies around Europe, introducing them to funds and high net worth investors to raise money. He said to me, the venture exchange is not even viewed as a real exchange in Europe anymore. You're better off to go to AIM. He said he listed a silver company on AIM last month, raised them £1 million. They've got volume and they've got support over there. So here's a guy for the last 25 years that has been as involved in the Canadian venture market as I am, and he's just written it off.
Don, is there a website people can go to find out more about this and perhaps get involved with the issue?
Well, people can contact me and I can put them in touch with people that are involved in this. I've got a website which is venturebeacon.ca. I post articles and blog comments on it, and I'm more than my phone number and everything's on there if you go to the contact tab. And I'm more than happy to talk to anybody about it. It really is a problem that a majority of Canadians are ignorant, and if it doesn't impact them directly, they don't understand and don't care about it.
Don, thanks a lot for chatting with This Week in Money.
My pleasure. Have a good day.
My guest has been Don Mosher, business consultant. His website, venturebeacon.ca. Coming up, Tim Cyclesman Wood on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. Welcome to This Week in Money, Tim.
Jim, thanks for having me.
One of the things you have found very frustrating is that using your cycles and very, very accurate predicting of what's happening in the markets, people no longer want to hear negative news, and it's hard for you to get the message out that this is one of the very worst times to be invested in the equity markets.
Jim, you are 100% right, and my mind goes a number of directions with that. So let me just try to tackle it and wrap it up in a package, so to speak, for people. But the thing is that people think in a linear fashion, and they can't help it. I mean, it's just I'm not being negative about people or demeaning anyone. It's just they're experts at what they do. And I feel like I'm an expert at what I do, and I feel like that when you venture on the other side of the fence and start trying to do somebody else's job, well, you don't know what you don't know, and so it's hard to make intelligent, informed decisions when that's not your thing. And so I don't want anybody to be offended and you sound like a know-it-all or anything, but here's the facts. I use statistics, cycles analysis, Dow theory, and the like to make the call in 2000 and said that the market would go below, specifically the industrials would go below the 1998 four-year cycle low. I was laughed at. It was published. It's in a magazine. I've got the magazine. I can pull it out. I can produce the article. It's not smoke and mirrors. I was laughed at, and 18 months later it happened. In 2005 and 6 and 7, as the market stretched and stretched and stretched and stretched, I said, no, this is an extended four-year cycle, and this is going to end very negatively, and it's going below the 2002 four-year cycle, and gave all the reasons why, all just based on statistics. The same thing with gold in 2008 and 2011. The same thing with housing in 2005. I don't know anything about housing, but I understand what the charts are saying, and I've wrapped the statistics around that data, and I know charts and statistics and how to extract that data. And it's not that I'm married to a position. I heard people one time, they said, oh, well, he's a gold hater. I mean, seriously, a grown man is going to call me a gold hater? It's just data. I'm just analyzing the data. And so I was right. And, another great call was the peak oil thing. When everybody was saying oil was going to $200 a barrel and we had T. Boone Pickens on and talking about peak oil and all this kind of stuff, I made the call on oil 1 week after the top and gave the reasons why, all based on statistics. It's a year before last now because we're in a new year. Back in 2014, based on statistics, and you've got the letter, said that crude oil would go into the 20s based on statistics, and it did. I said all that to say this. I'm not boasting about the calls. The past calls do me, you, or nobody else any good. I'm saying that to try to make people understand that this stuff works. And as extended as this market is, I have said for a couple of years now, it's an extended 4-year cycle, it's an extended 4-year cycle. I can't change that fact. That is a fact. And all the while this thing has stretched and 15 was by and large a topping process, it's still an extended 4-year cycle and the statistics still apply. And I was doing an interview with a guy yesterday who's well connected in the financial industry, and I made the comment to him that one of the most fascinating things about this current market environment is that there's no fear. People don't understand where we're at, how we're set up, what the dangers here. And I made the comment to him, I said, I saw more fear going into the August low than I see in sense right now. And he said he agreed 100%. Yet the market is more dangerous here. Now, I say this on a day that the market is up, and I say this on a day where I think we have an intermediate degree low and where I think this market is going to rally for, some period of time. And in the process of that rally, it is going to revitalize the bulls. They're going to perceive that, okay, that was ugly, but you know what? It's over, and they're going to get a comfort level. The bears are going to doubt themselves again, just like they did as the rally came out, out of the August low. It's going to wash them out, and then the market is going to be set up for, I think, the trap door to open. And people, they don't get it. They just don't get. They don't understand. And then, after the fact, it's just too late. It's just too late. And I was talking to a friend, talking about linear thinking. Last week, he was watching the price of crude oil, and it's down to, I told him a couple of years ago it was going in the 20s, and I hadn't talked to the guy in a while. He calls me, and he says, man, you were right about that. He said, it's going to be 25 by Friday. And I said, no, I think it's putting in a bottom. No, it's going, man, the way this is dropping, it's going to 25 by Friday. And it was kind of comical, and I said, no, I'm thinking it's putting in a little short, at least a little short to intermediate term bottom here, and it has bounced. And my point is, that's the linear thinking. That's just human nature. And, I just can't stress enough the environment that we're moving in here in the next few months. And I realize I'm totally aware that the market is up here. I'm totally aware that, more so than most of the listeners, I'm sure, that there is an intermediate degree, advance underway. And I know what it's going to do psychologically to people. And then I think, like I said, the trap door is going to be set to open.
Tim, I think some people have listened to you. They just did a survey in Canada, and people have put themselves into cash. Something like $75 billion in private investment cash is sitting there on the shelf because people don't know where to put it right now, where it might be safe, and until they find a safe place, they're not investing it. Businesses have $800 billion sitting on the shelf. So, Tim, not everybody has fallen deaf to your warnings. I think many have listened.
Well, that's good. That's good. I feel like I'm singing from the rooftops and people aren't listening. And I know, I know there's questions. I know that there's doubt. So I hope you're right. And obviously I can't argue with, hard, cold facts that say that people are on the side. The problem is that a lot of people, they think they always have to be in the market, and you don't. It's like an old man told me one time. He said, you can be aggressively long, you can be aggressively short, or you can be aggressively on the sidelines. And there's a time for all three. And so you don't always have to be invested in the market. That all said, once the flush out comes, the positive is to avoid it, to understand the timing of it, to be able to avoid the false bottoms along the way, and then to be able to step in once you're at the bottom. And I see some things coming on the horizon for gold. I know that there's a number of gold bugs out there that listen to these interviews, and I've been negative on gold since the 9-year cycle top in 2011. But, I see some stuff on the horizon later this year that is very positive. But, things have to run their cycle. But I think there's a flush out coming, and then as things set up, there's going to be tremendous opportunity.
Tim, what do the cycles tell you what we're going to see coming up this year, and where should you get the hell out of Dodge, and where should you park your dough until it's good to go?
Well, like I said, I think we're at, if we haven't seen it, it may come with one more push down, but I think we're at or very near an intermediate degree low. I tend to think that we've seen it. And like I said, I think that is going to play the psychological or have the psychological effect on people to make them think that, okay, this decline in January was, like I said, it was ugly, but it's over now and better times are ahead. But that's not the case. It's just not the case. The statistics, the cycles, and everything point toward this being a brutal year. And I think the place to be is, like I said, aggressively on the sidelines until we get to these cycle bottoms. And then, kind of like dominoes, I think everything's going down pretty much together, all asset classes. And then, with the exception of this bounce that I think have started here. And then, there will be opportunity. Like I said, I see tremendous opportunity coming up, with the flush out, in gold stocks. And then I see a tremendous opportunity, with equities, but we're not there yet. We haven't even begun. I mean, we have to get to those bottoms.
Tim, why do you think we have seen so little coverage of the risks that people are taking on the financial networks in the financial papers?
Because they're never going to report that. And, they're just not going to do it. And as a matter of fact, I've told you this story, and so help me God, it's true. Back in the day when I made the call in 2000 about the top, back then you could pick up the phone and you could call and you could actually talk to some of the CNBC reporters. It was a different time then. And I had talked to some of them, and I'll leave them nameless. There's no point in that. But I had dialogue with one of the guys. I was sending him I actually sent him the article that was published, and then sent him some of the research letters. And he just told me point blank, he said, I can't have you on to say what you have to say. And the same thing with some of the other financial agencies today. They still will not listen. They don't want the message out there, and refuse to have me on. And the point, why? They can get on and talk about all the terrorism and stuff. That's negative, but they don't want to hear about the financial stuff. And I think I don't know why. I can only speculate as to why. My speculation is that they will want to add fuel to the fire, so to speak. But if you think about it, have you ever seen a financial institution or a financial reporting agency really cover any kind of major top? Did they cover the 2000 top? No. The 2007 top? No. Did they tell you that oil was going to crash? No. Did they tell us? Greenspan himself denied the housing bubble, and Stevie Wonder could have seen that. So they're not going to tell you, and it's just the way things are.
Tim, I know you said you're frustrated. How do you get the mainstream media to pay attention to something? After all of us hope to have good retirements with good income and so on. But if we have another devastating round in the stock markets, and pension funds are heavily invested now in stock markets, what are you going to do for those poor folks who are about to retire and are going to see their registered retirement savings get devastated again?
They're going to be decimated. They are. And it's sad. I can't remember if I heard it, where I heard it. I can't remember if someone told me this story that is a subscriber and a money manager, or if somebody told me at the gym. But someone was telling me about an elderly person that was, I think it was maybe a subscriber was telling me this. He's a money manager, and he said that this guy with the market being down here, that he doubled down, so to speak. I mean, he even committed more money to the market because he had some money on the sideline and he saw this as a buying opportunity. And he was telling me that, as risky as this market is here, he was agreeing that people aren't seeing that risk. And so, it's unfortunate, but people are going to be hurt, and when they are, they are. There's nothing that you or I or anybody else can do about it after the fact. They can try to open their minds. Either they have the eyes and ears to hear and the desire to do the research, which, I have hardcore fact data available to support my opinion, and either they can do research and look at that, or they don't. And if they get caught in the crossfires, then you know what? Shame on them. But there's nothing that you or I can do if people don't have the eyes and ears to want to hear, figure it out, and get out of the way. As far as the media, I don't mean to say this the wrong way. I don't want to make anybody mad, but you got to call a spade a spade. They're whores. They're not going to tell you the truth, and they don't care about someone losing their retirement, obviously.
Well, I was going to say, when I watch the local television news, sometimes their lead story is a lost dog at the airport. And of course, that's not going to affect my life in any way whatsoever. But yet, I'm sure when it comes to financial events and news, they say, well, to the average person, that's boring. They want to see stories about lost dogs rather than hearing that their savings account is about to be cleaned out because the banks have driven themselves into bankruptcy again.
Well, you're right. And when I say whores, are whores to Wall Street, to the brokerage firms. And I mean, rather than, the man that's worked all of his life to try to, like you said, have a retirement and to be able, the average guy's been forced in the market when he probably shouldn't have been there anyway. And due to the stimulus and everything, they've kind of bailed him out. But here we are now at another, very bad spot for the market. And, there's going to be some tremendous losses. And, to think that the people really care about you, I think that's naive. I just don't think the media does, because they've never, all you have to do is ask yourself, have they ever reported any of these financial events before the fact? I mean, you might pick up one little blurb here or there buried amongst all the other cheerleading, but there's nothing of any significance. They're not going to report it.
Tim, how can people subscribe to your newsletter so they get a better heads up on what's happening with the markets?
It's tim@cyclesman.com. You can send me an email, but cyclesman.com on the website. And like I said, it's just data. It's just research. And it's emotionalist analysis of the market. It just is what it is. And I have no axe to grind as far as cheerleading a team that this goes up or that goes down. I mean, I could care less. I just want to get it right. And I think you've been reading my letters long enough and see them to know that, these calls are real. And, I guess the thing that I'm kind of pleading to is the average guy who has worked all of his life and to know that there's research and information out there that can help them make a better decision. And get out of the way. I hate to see, the average person hurt like they're going to be if they're caught in this.
Tim, thanks for being on This Week in Money.
Thank you for having me.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. That wraps up our show for this week. Thanks to our guests, Ross Clark, Don Mosher, and Tim Wood. And thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.